Do you want to calculate your monthly loan payment in Excel in just a few seconds, without complicated financial formulas? In this video, I'll show you how the PMT function works, what each argument means, and how to calculate payments for mortgage, auto, and personal loans with practical examples. Before we jump into the examples, let's quickly explain what the PMT function actually is. This function calculates a fixed periodic loan payment, assuming the interest rate remains constant throughout the loan term. Here's what each argument means. Rate, the interest rate per period. If the annual interest rate is 12%, divide it by 12 for monthly payments. NPER, the total number of payment periods. A 5-year loan means 60 monthly payments. PV, the present value or the amount you're borrowing today. FV, optional, the remaining loan balance after the last payment. In most cases, this is 0. Type, optional. A value of 0 means payments are made at the end of each period, while 1 means payments are made at the beginning. One important note, the PMT function returns a negative number because Excel treats loan payments as cash outflows. If you want a positive result, simply place a minus sign in front of the function. Let's start with the most common example, a home mortgage. Suppose you're taking out a $150,000 mortgage for 30 years with an annual interest rate of 3.5%. Notice that we divide the annual interest rate by 12 because we're calculating monthly payments, and we multiply the number of years by 12 to get the total number of monthly payments. Excel returns a negative number because the payment is money leaving your account. If you'd rather see a positive value, simply add a minus sign before the function. Now imagine calculating this manually. PMT does it in less than a second. The car costs $20,000. You finance it over 5 years with an annual interest rate of 7%. We'll also enter a down payment of our choice. The monthly payment comes to about $396. Short-term loans have fewer payments, but higher interest rates tend to have a bigger impact than they do on long-term loans. Now change the down payment amount and watch how the monthly payment changes. For each bank, enter a PMT formula that references the corresponding cells. This way, whenever you change the interest rate or loan term, the monthly payment updates automatically. For example, the difference between loan offers for a $50,000 loan over different repayment periods isn't just a few dollars. It can amount to hundreds or even thousands of dollars in total interest paid over the life of the loan. This table instantly answers the question: which bank actually offers the better deal? Now let's build the most useful project in this video, your own personal loan calculator. Use data validation to create drop-down lists. Below these inputs, enter a PMT formula that references those cells. Now, whenever you change any value from the drop-down lists, the monthly payment updates automatically. In just a second, you can compare a loan with a 10% down payment versus 20% down, or see how extending the repayment period affects the monthly payment. This is the kind of calculator you'll find useful before making any major purchase. Most people know their monthly payment, but they have no idea how much they actually paid the bank in total. The calculation is simple. Take your monthly payment, multiply it by the total number of payments, and subtract the original loan amount. Whatever remains is the total interest you paid to the bank. Once you see these numbers in Excel, you'll understand why financial literacy is so important. This example demonstrates the power of the FV argument we mentioned earlier. With a lease, you don't pay off the entire value of the vehicle. At the end of the lease, the vehicle still has a residual value. Let's say $20,000, which you either pay to purchase the vehicle or simply return the car. The fourth argument is the future value, $20,000. Excel now knows that it doesn't need to finance the entire amount, so the monthly payment is lower. That's why lease payments are often lower than traditional car loan payments. But at the end of the lease, you either pay the remaining balance or return the vehicle. The PMT function is one of those Excel functions that takes just 5 minutes to learn, but can save you thousands of dollars over your lifetime. Now you can walk into a bank much better prepared, understand the loan offers you're given, and and verify for yourself what your monthly payment will actually be. If you found this video helpful, share it with someone who's planning to take out a loan, and support the channel by liking the video and subscribing. Thanks for watching, and I'll see you in the next video.